Reliance Industries, it's made history just a few days back, becoming the first Indian stock to cross the 8 lakh crore market cap. That makes it one of the most valuable companies in the world. But what does it do to valuations and how does it stack up against its global peers in the oil and gas space? Somit standing by with the answer. Somit, was it too expensive? Because the last few days we've seen Reliance cooling off a bit as well.
Well, it has become now too expensive. Earlier it was not actually. Now, obviously after that rally it has become, and so we saw some cooling off. Now, if you see, there are only 103 companies in the world which have a market capitalization of more than $100 billion. Of this, only 8 companies belong to the oil and gas space, and of these 8 companies, Reliance Industries has risen the most. It has risen nearly 40% in 2018, and this rally in share prices have now made Reliance Industries the world's most expensive oil and gas company. Now, I'm just showing here the price to earnings valuation metric, but if you check any other valuation metric, that is price to book, EV to EBITDA, it is expensive on all the valuation metric. Now, on P, if you see, the consolidated 12-month forward price to earnings for Reliance Industries is close to 16.7 times, while the standalone is at around 18.3 times. Now, this compared to its 5-year average, which is close to 12.3 times, and when you compare this with the peers like Exxon and PetroChina, they are trading at around 15.4 times and 14.9 times. So you can see how this rally has made Reliance Industries the most expensive oil and gas company in the world. Now, if you see the share price chart of Reliance Industries, most of this rally has come in the last 2 months. Now, in the last 2 months, the share prices, the market capitalization of Reliance Industries, now that has increased from 6 lakh crore rupees to around 8 lakh crore rupees. It has added nearly 2 lakh crore rupees of market cap in the last 2 months, and that has made now Reliance Industries the most expensive oil and gas company.
Very interesting. So, Somit, the question arguably comes in is what's fueling the rally? Is it performance across the divisions which is leading Reliance to become such an expensive stock?
So, firstly, it is the strong Q1 numbers. Now, I won't dwell much into the numbers, but just a few highlights. The standalone EBITDA of Reliance Industries in Q1 grew around 13%. That was the highest growth, quarter-on-quarter growth seen in the last 13 quarters. Now, this has not only confirmed but also increased investors' expectation of a robust energy segment performance going forward. Second was the retail business. Now, this was underperforming earlier and not contributing much to the consolidated Reliance Industries. But given the current consistent performance of this retail business, investors have now started to give this business a higher valuation. And third, it was Reliance Jio. Now, despite tariff wars, the company's profits and margins both have been continuously increasing. And along with this, the company has now also entered into home broadband and DTH space. Now, this has increased the investor optimism given the recent success it has seen in the telecom venture. Now, sticking to the telecom business, 2 important data points that came in the last 2 months. First was the subscriber data. Now, in the last 2 months, the Reliance Jio has added nearly 1.9 crore subscribers, which is the highest when compared to peers, and this has been continuously increasing for the Jio business. And second was the revenue market share. Now, in Q2 FY18, when Reliance Jio reported its financials for the very first time, its revenue market share was close to 11.6%, but now it has largely doubled. It has increased to 22.6% in the first quarter of financial year 2019. Now, lastly, on the refining business. Now, refining business of Reliance Industries was also a bit subdued of late in the last 2-3 quarters. If you see, the refining business was not performing as much. But given the recent strength in the Singapore gross refining margin, the earnings outlook for the refining business has also improved. Now, if you see the Singapore gross refining margin, it has strengthened, which is the Asian benchmark. It has strengthened from $4.8 per barrel to close to $6.8 per barrel in August 2018. Now, higher gross refining margin means higher earnings for a refiner, and especially for Reliance Industries, if you see, other than this strengthening of the Singapore gross refining margin, as and when the Reliance Industries plants are ramping up and getting more used, the gross refining margin for Reliance Industries is also expected to increase by another $1.5 to $2 per barrel. So this strength in Singapore gross refining margin plus ramping up of new plants would add another $2 per barrel to its Singapore gross refining, to its GRMs. So to sum it up, it's the positive earnings that was there in the first quarter, positive expectations of the new DTH business and the broadband business, strengthening and a good earnings outlook for the old lagas, that is the refining and the retail business, has fueled this rally for Reliance Industries in the last 2 months.